for years, we used to talk about Apple and Apple getting bigger and bigger, and people used to talk about deceleration. And it just felt like in the last few months we were doing the same thing with Nvidia. What was your reaction to that outlook from that company?
Well, I appreciate the Apple analogy, John. Actually, it's something that I've been thinking about more recently, that growth that Apple had. And just to put into perspective, what's happened with Nvidia over the past few years and looking towards next year, calendar 22, Nvidia did $27 billion in revenue. Calendar 27, so 5 years later, they'll likely do more than $700 billion. It's probably going to be $750 in revenue. So 27 to 750. The reason why I say that, and in the comp relative to Apple, is that what's happened with Nvidia has been breathtaking, even relative to the iconic tech moves that we've seen. And so the key takeaway here is less about what we've seen from 22 to 26. It's more about what we're going to see from 27 to 30, to get to your point here. It's been well documented here about the numbers, the guidance, the plus 70% revenue growth rate versus the street at plus 45%. That's for calendar 27. That was kind of the eye-opener from a couple nights ago. I expect that next year, calendar 27, will probably grow at 90%. That means that the growth rate in calendar 27 will be about the same as it is in calendar 26, 90%. And I think at the core of what's going on here, if we just look at the business, forget about the big picture with AI, but just if we look at Nvidia's business, at the core of what's going on is that the customers simply just can't get enough capacity to do inference. And that is what is driving these numbers up. And ultimately, I still believe we're probably in the third inning of this build-out. Sounds hard to kind of wrap my head around that.
Almost
but
impossible.
I still think we're very early.
Gene, I really struggle with that, but that's the way things are heading. Gene, when you look at this company, one unique part of the way they operate is they look to foster and create their own demand by helping to build out the AI ecosystem elsewhere. What would you point to as a unique feature of that?
Well, I think from the demand side, it's just the speed of their chips that ultimately is what is driving all this. And that's what's allowing them to have this incredible pricing leverage. Kind of next year, probably 20, 30% potential pricing increase on some of their products. And I think that's the piece, John, that gets missed in this conversation, is that ultimately consumers or their customers really need these chips more than any other custom silicon. And so I think that's a big key takeaway here, is that they basically have the best stuff in town.
What then do you make of some of the other moves they've been making recently, Gene? Maybe lost in the news flow of that huge gain in earnings they had yesterday was the fact that they bought Hugging Face, a big platform for open source modeling and discussion. They have their own open source that they're working on too. Gene, what exactly is Nvidia doing there?
So this is an important dynamic in terms of how Nvidia sees the progression of models. And so what Hugging Face is for those who are more technical, it's effectively the GitHub of AI development. For those less technical, it's a library of open source AI models that people who are developing AI can basically pull thousands, hundreds of thousands of models and plug and play them into the development. And so that's what this is. The big picture here, Danny, is this is the theme around open source. And this is something that Jensen's been very supportive of. But there's a story underneath the surface that I think is more important to what the headlines are, which is Hugging Face is progressing Nvidia into the open source world. What's most important here is that Nvidia is basically building out, is doing the inverse of what their customers are doing to them. So just stick with me for a second here. If you look at customers like Meta and Google, they are building their own custom silicon. Effectively, they want to compete, or they want to have alternatives to Nvidia. What Nvidia is doing here with Hugging Face, what they did last week with Poolside, a small acquisition, is essentially they're building their own models in the event that their customers, their current key customers, start to do more of their custom silicon. They have an advantage to focus more on the models themselves and make money from the models themselves. It's just a fascinating dynamic. As tightly as these companies, the mega caps and Nvidia, hold their hands, Nvidia is also getting some diversification in case those customers start to do their own custom silicon.
Well, there was also in the earnings outlaid some other hedging, just looking to other customers besides the hyperscalers, looking to sovereign AI as well as to enterprise. Gene, does that seem like a growing, at least the pace of growth fast enough versus their historical customers to kind of alleviate some of the concerns over concentration risk?
So the customer concentration, actually the top two declined in terms of total percentage of revenue, went from 38% in the April quarter to around 30%. And the reason is SpaceX basically came out of nowhere. It was a couple percentage of total revenue in the April quarter. It was probably about 5% in the July quarter. So they are getting some diversification within that. But to your point is the script is flipping in terms of where they're getting their growth from. If we're looking at for next year, those hyperscalers are expected to grow revenue just over 50%. If you look at the non-hyperscalers, the sovereign, like you mentioned, they're expected to grow around 85%. So why that's important is that what investors struggle with here, when we started and talked about this breathtaking increase in numbers, it's less about the law of large numbers. Google is a similar sized business. The issue is the slope of the deceleration of revenue. And as the non-hyperscalers grow, that gets investors more comfortable that decline from 90% next year to maybe 50% in calendar 28 won't be as sharp. And so I think that this customer diversification, this script flipping in terms of focus more on non-hyperscalers is an important piece that allows investors to sleep just a little bit better at night, knowing that that growth curve isn't going to be as sharply declining as maybe some think today.